Good morning, everybody. You're very welcome to our annual financial services spring briefing here this morning. People are still joining, so I'll give it a minute or two. As those of you who have been with us in previous years for this event will know, the object of this session is to take stock as we look forward for the year ahead, to survey current economic conditions, and also to look at some legal developments that we think might be particularly relevant also to the financial services sector. It's become a bit of a cliche now to say that we're living through a period of volatility and change, but it does feel like it's really heightened at the moment with the geopolitical tensions that currently exist between the West and Russia and China, and also economic uncertainty around the prospect that we may be about to enter an ultra high inflationary period. And because Ireland is such a small open economy, we're particularly exposed to volatility, and its effects tend to be exaggerated for us both on the upside and the downside. So it's really important that we pay attention to those economic signals. To help guide us through those issues, we're very pleased to once again welcome back Seamus Coffey, who will provide his insight into economic conditions in Ireland at the moment. Seamus brings a unique perspective as a lecturer in economics in University College Cork, and also having previously chaired the Irish Fiscal Advisory Council, which, as we know, is the statutory body charged with assessing and commenting on the government's budgetary and economic policies and forecasts. So essentially checking the Minister for Finance's homework. So this gives Seamus a unique understanding of how government frames its economic policy, and we look forward to his insights this morning. Before we hear from Seamus, Liam Flynn, the co-head of the Financial Regulation Group here in Mason Hayes and Curran, will consider whether financial regulation can be both prudent and pragmatic. Unlike in Ireland currently, in some countries, financial regulators have now been given mandates by their governments to grow their financial services industries as well as regulate them. And Liam will consider whether those two objectives can coexist for regulators. Then Sarah Cloonan, who's a senior associate in our financial regulation group, will look at the 2022 action plan for the Ireland for Finance strategy, which is the whole of government strategy for growing the financial services industry in Ireland out to 2025. That action plan sets out a number of specific priorities for 2022, which Sarah will run through for us. After his presentation, then Seamus will take questions from the audience and we'll have a chat. So please do make the most of that opportunity. You can use the Zoom Q&A function, and I'll try to get through as many of those questions as I can in the time allowed. And also, if anyone has questions for Liam or Sarah, we'll take those at that point as well. So just input your questions on the Zoom function and we'll work through those in the Q&A. So I hope you'll gain some insight this morning and find the session informative and helpful as you're planning for the rest of the year ahead. So firstly then, over to Liam.
Thanks, Will. I'm Liam Flynn, as Will said. I'm co-head of financial regulation here at Mason Hayes. I've spent time in both the private sector and the public sector in the UK, Ireland, and also most recently in Basel in Switzerland at the Bank for International Settlements. So what I'm going to say is informed very much by those experiences and its personal views, obviously, as it always is. Can regulation be business friendly is the question. I met a colleague in the lift yesterday and he said, you'll be giving a short talk tomorrow. And I said, how's that? He said, can regulation be business friendly? No. Now, my own view, and I put my cards on the table straight away, is that we can have a regulatory system that is a long-term help and friend to business, provided that the system can balance potentially conflicting objectives, such as growth, financial stability, and consumer protection. And just rolling over to the next slide, please, Sinead. The key development here that I want to focus in on is the UK Treasury's Future Regulatory Framework Review, published in November last year. Our friends and neighbours in the UK have, in reviewing their regulatory system and where they wanted to go post-Brexit, decided that the government should revise regulators' objectives to reflect the need to support the long-term growth and international competitiveness of the UK economy, including its financial services sector. Now, one thing that's very important, this was a bombshell. I mean, it had been long lobbied for by business groups in the UK, but it was, I think, something of a surprise that government embraced it enthusiastically. One point to note here is that the proposal is to add growth as a secondary and not a primary objective of the regulator. And that's very much in accordance with what is still prevailing international best practice on regulatory theory, that financial stability is the primary and should be the primary goal of regulators worldwide. Interesting also to note that the UK in this regard has been on a journey, because in 2011, the former mandate of the then Financial Services Authority to promote global competitiveness of the UK and innovation in financial markets was removed following the global financial crisis. So turning over the slide, please, Sinead, to what we see in Ireland and what the background to this debate might be here. Now, we'll all remember the Honohan report, Governor Honohan's report of 2010, which pointed to the potential conflict, and that's important, potential conflict. Governor Honohan didn't say there was definitely a conflict, an established conflict, but that there was a potential conflict between promoting the growth of financial services and promoting financial stability. And as a result of that, the growth mandate, which the former financial regulator had, was removed in the Central Bank Act of 2010. That position's been staunchly maintained. Really, the debate's been off the table, if we're honest. In 2017, Governor Lane of the Central Bank wrote a letter to the Shannon Select Committee on Brexit, staunchly defending the position that the Central Bank should not have a growth mandate or a promotional mandate, and saying, I know of no comparable central bank that has such a mandate. I guess some of that depends on how you define comparable. The UK regulators in their November 2021, or rather the UK government in its November 2021 review, identified Australia, Japan, Singapore, Hong Kong, and Switzerland as regulators that already have growth mandates. So there is movement in this respect internationally. And it's important also, I think, to bear in mind that the former growth mandate that the financial regulator had was always expressed as being subject to maintaining stability. So very similar, and not quite the same, but very similar to the current UK proposal. So rolling the slide over, please, Sinead. If we try to think about design of a regulatory system and regulatory objectives from an economic analysis of law perspective, and ask about the design of a system from in terms of its legal structure and regulation, from the point of view of achieving the most efficient economic outcomes, there's a general consensus that good regulation should result in increased and better quality growth in the long term. Markets are clearly imperfect, so regulation is essential to produce public goods that wouldn't otherwise be produced. But there's also a recognition that regulatory measures often have unintended and unforeseen consequences. So From an economic perspective, it's critical to put in place legal measures to mitigate against those unintended and unforeseen consequences. And some of those measures, and the UK paper talks in some detail about this, are measures like good cost benefit analysis, which is hard in the regulatory context, but not impossible. Independent scrutiny and oversight of the regulator, transparency of process, and meaningful stakeholder engagement, which is on a statutory footing in the UK, quite extensive stakeholder engagement. But what there doesn't seem to be much economic analysis on is, can or should a regulator have a mandate to deliver several conflicting public goods, and can that produce efficient outcomes? So rolling the slide over, the final slide, Sinead, please. Conflicting objectives are inevitable. I mean, there's a recognition in the central bank literature itself that financial stability, is the BIS in 2011, financial stability is necessary, but it's not sufficient to deliver growth, long-term balanced growth with equity. There's some academic commentary to the effect that regulatory goals will conflict. Consumer protection may conflict with financial stability, but the key thing is that it's necessary to develop a framework for resolving those conflicts. Now, our friends and neighbours in the UK will need to develop a framework to resolve the tensions that undoubtedly will exist or could exist between a potential growth mandate and a stability mandate. And I guess I would be asking the question, is it not time 10 years after the bailout and the collective trauma that we all endured to open up that discussion and ask in Ireland, what do we want from our regulatory system? I'll leave it there. My colleague, Sarah Clunan, is now going to speak, and this is obviously all feeding into the government's strategy to promote Ireland as a key financial domicile in Europe. And Sarah's going to talk a little bit more about that. Over to Sarah.
Thanks, Liam. So as Liam mentioned, my focus for today's discussion is the Ireland for Finance strategy, which was originally published back in April of 2019, and which essentially maps the proposed development of Ireland's international financial services sector up until 2025. So we'll just move on to the first slide. So as I mentioned, that strategy was put in place in 2019, but for the purposes of my discussion, I'm going to focus in more particularly on the action plan for 2022, which was published earlier this month, and which covers a number of different themes, all geared towards meeting this aim of promoting the financial services sector in Ireland. So those themes range from sustainable finance, diversity and inclusion in the financial services sector, and then also the operating environment in which the sector operates. So why do we need an action plan? There's one key theme in respect of fintech and digital finance that's set out in the action plan that I'm going to focus on. And there are a number of different reasons why we need an action plan on this particular theme. I think it's fairly obvious to all of us that over the past couple of years, and with the restrictions that COVID brought, businesses had to really learn how to pivot in order to continue to serve their customer base. And technology played a real big role in that. And financial services also had to make use of the technology available to it in order to survive. Another key reason I think why we need an action plan when it comes to fintech and digital finance is the government's focus on financial inclusion. So this really points towards ensuring that the wider consumer base is comfortable with using the technology and how it interplays with financial services for the purposes of increasing their financial well-being. And this, I think, is in tandem with, at European level, the 2030 digital compass that was put in place early last year. And again, which is geared towards ensuring that the digital network in Europe is enhanced and accessible to all. And similarly, at a national level, we have the new digital strategy, which essentially maps how Ireland is going to ensure it achieves the goals that are set out in that digital compass for 2030. And then finally, I think another key priority of the government at present is ensuring that Ireland is recognised as a global hub and Centre of Excellence for InsurTech. So all of these have fed into the action plan and what's going to be taking place over the next few months and for the rest of this year. So there are a number of priorities set out in the action plan, and I'm briefly going to touch on a number of them today. So to kick off, we have the Fintech Steering Group. So this steering group was initially put in place in 2021 by the Department of Finance. And I think it was really in recognition of the interplay between finance and technology and what advantages it could bring. So really the focus this year for that steering group is to further enhance its activities. So there'll be a few things they'll be working on. Number one will be the development of more policies around fintech in conjunction with other government departments. And we'll also have consultations with the fintech industry and other stakeholders as well to identify opportunities in the fintech space. More research will be carried out as to what can be done to enhance the industry. And then also at EU level, the steering group will be more heavily involved in development of policy at that level as well. There'll also be an expansion of the membership of that steering group to include representatives from other departments in government. And then similarly, there'll be some working groups established with some of those representatives and other industry stakeholders to further advance the work in the fintech space that the steering group identifies as necessary. I mentioned earlier the aim to increase Ireland's profile as an InsurTech hub and centre of excellence. And really the focus here will be on instech.ie, which is a not-for-profit organisation that was established to promote Ireland in this area of the industry. So they, like I said, will be working further this year on promoting Ireland, but also mapping out the ecosystem that's in place at the minute in the InsurTech space in Ireland. They'll also be working on innovation and partnerships in that space between research institutes and companies that may spin out from third level education. And then finally, they'll also be focused in on an innovation forum whereby insurance companies will be encouraged to procure the products and services that our existing Irish insurance or startup companies or fintechs can offer to those insurance companies. So again, an important piece of the action plan for 2022. And the next one I'll just touch on is the support for the growth of Irish owned fintechs. So here really Enterprise Ireland will be playing a key role. They will be hosting a number of activities and events across the globe in the markets in which those fintechs are likely to want to export their services. So that'll include the likes of the US, Australia, and the APEC region. And in addition to hosting events to, I suppose, attract new customers for our fintechs, there'll also be a focus on activities to gear towards helping the fintechs themselves so that they are prepped and ready to go into those markets and, you know, are prepared and don't incur or encounter any surprises and are successful in the goal to further grow their businesses. And then finally, the last priority I'll touch on is promoting Ireland as a fintech centre of excellence. So this somewhat overlaps with the previous priority in respect of InsurTech. But here the Department of Finance will be playing a key role in arranging a host of activities with, I suppose, 3 goals in mind. Number one, further enhance Ireland's reputation as a fintech centre of excellence across the globe, support our existing and upcoming fintechs that want to export their services across the globe and in other jurisdictions. And then finally, to attract multinationals in the fintech space and to encourage them to set up operations here in Ireland. I think it's clear that as an economy, we've been very successful across on that goal across a number of different industries over the years. We've a young, educated workforce. We attract talent from other countries across Europe and elsewhere. And hopefully that will encourage the multinationals on the fintech side to also come to Ireland and set up base here. In addition to those priorities and activities that will take place, there'll also be some activity from our trade associations. So we'll have the Banking and Payments Federation issuing a number of opinion papers on topics such as open banking, data and digital assets. And the Irish funds industry will also be issuing a white paper on digital and crypto assets. So again, things to look out for over the coming months. The last thing I think I'll just touch on in respect of the action plan is the recognition in the action plan that the central bank, as the regulator, needs to be future focused. And this is a priority of the central bank going forward. And I think is mirrored by the innovation hub that's been put in place as a sandbox of sorts for fintechs and up and coming startups to use to test out their products. And also, I think, as a resource for the central bank to gather information so that it is well placed to react to this fast pace of technology and financial services and what it brings to the market. Fintechs and startups are really going to be focused on speed to market. So, the support of the central bank in that regard across the board will be really key in ensuring that those fintechs are successful when they do bring these innovative products to the market for consumers. And I think I'll leave it there and I'll pass us back to Will.
Thank you very much, Sarah, and thank you, Liam, as well. An interesting little snapshot, actually, of what's happening in the on the financial services regulation side at the moment. So now we're going to hear from Seamus, who's going to have a look at the the economic outlook for Ireland for 2022. I was Seamus, as well as your impressive academic and public service accomplishments, I was most impressed to learn recently that you're still togging out for Capamore Junior B hurlers and helped them to a Limerick County final there in the last few years. So if we've time at the end of the Q&A, I might ask you a couple of questions about that. So over to you, Seamus.
Thanks very much, Will. So I'll just briefly get my screen set up, on screen share. So as Will set out, we're going to look over the next couple of minutes, maybe just at a quick update of the economic position we find ourselves in, and focus then on maybe some of the hot button issues that are likely to impact over 2022. So it will be not a wide-ranging update. We will focus on a particular number of issues. And when it comes to looking at issues, we'll try to break them down to maybe things that are influenced by international or global effects, and then maybe move and look at what might be more domestic or national issues, looking at the build-up of savings and maybe what's happening to credit in the Irish economy, and then to conclude a bit on the public finances, and looking with what's happening with corporation tax and just the scale of the revenues being received. And I think for all of these issues, what we're seeing at the moment is that things are going up and up. But what happens after that? Are we going to continue on this upward trend? Is there a fear or a risk with some of these that maybe we'll end up flying too close to the sun? And what could be the consequences of that? But I think these are maybe some of the issues that are getting a lot of traction at the moment, and hopefully over the next quarter of an hour, 20 minutes, we'll put some insight into them. So why is inflation getting a certain amount of attention? And I think one reason has been the change we've seen in the past few months. So this is the Irish inflation rate as measured by our Central Statistics Office over the last 20 years or so. This goes back to 2003. And you can see it has varied. In the immediate aftermath of the crash of 2008, it went significantly negative. A brief period where the inflation rate was -6%, some of the froth of the Celtic Tiger washing out. The inflation rate recovered, but for the last 5, 6, 7 years, inflation has essentially been absent. If you look at from 2014 on, it was pretty much close to zero, few deviations around it. But in general, it was below the EC target, which was inflation of close to but below 2%. But if we look at the last 12 to 18 months, we can see how significantly things have changed and how quickly they have changed. In the immediate period preceding the pandemic, inflation was maybe running at 1.5%. But even before the pandemic, in late 2019, early 2020, inflation was falling. But then as the pandemic struck, inflation turned negative. But for the past 12 months or so, inflation has reversed, turned positive, and reached a peak in Ireland of 5.5% in December. In fact, this chart is as up to date as we can get, because the January 2022 figures were released about 20 minutes ago by the CSO, and I just had enough time to input the figure for January into this chart, and it actually shows the inflation rate easing a small bit in January. It was 5.5% in December, easing to 5% in January. Not a huge change, but not continuing the upward rise we'd seen in the rate in the months preceding that. If we look at sort of the drivers of it, one key element with all inflation rates is the price of energy. And of course, from an Irish perspective, most of our energy is imported. Yes, we are producing some energy domestically, particularly when it comes to oil. We import all of that. And we can actually look at the consumer price index, excluding energy. So the blue line is the one we had previously. This one isn't updated for January 2022. So that the most recent figures there are December. And you can see there are times where the red and the blue line have diverged, where a key driver of the inflation rate has been energy. So the blue line includes energy. The red line is the CSO's estimate of inflation, excluding energy. And again, with most of that being imported. But in fact, the most significant divergence is what's happening now. If you look at the most recent outturns for the consumer price index, excluding energy, it's actually in or around 3.5%. Now, still significantly higher than it has been previously, and showing a very significant increase from where it was over the past couple of years. But it's not at the 5.5% rate that the overall consumer price inflation index has shown. So if we look at some of the drivers of inflation in Ireland, many of them are global. The current price of oil is around $95 a barrel. You go back 12 months ago, the price of oil would be around $60 a barrel in the midst of the pandemic, and of course with sort of geopolitical concerns and access to gas, the increase in the price of gas has actually been significantly larger. But one of the key drivers of inflation has been energy price inflation. And this one is practically vertical. So this is Irish energy price inflation. It is a much more volatile graph than overall price inflation. The range is from minus 12-13% immediately after the 2008 crash, up to 20% was the previous peak. The range has now been extended, and we're currently looking at energy price inflation of 30%. And this is very real. Maybe when you say you strip it out of your measure of price inflation, you're saying it's not happening. It absolutely is happening. The price of a barrel of oil is now 50% higher at the start of 2022 than it was at the start of 2021. And that is feeding through to price inflation, but it's not necessarily driven by domestic factors. And is it really a core or underlying inflation? If we're looking at the response to it, and our inflation is driven by energy, is changing interest rates going to impact on the price of energy? Is it going to impact on the price inflation driven by the price of a barrel of oil? So this has been particularly steep. And here, it's possibly we're looking at some base effects, or just the way it's calculated. Inflation is calculated on a 12-month basis. So 12 months ago, we were in the midst of the pandemic. There had been, as you can see, negative price inflation for energy for a period of time. The price had fallen. As we've progressed through it, particularly with the view of the Omicron wave that emerged in late 2021, and the fact that didn't have as significant impact on economies as might have been felt, or might have been predicted, we're seeing energy prices rise. And of course, we have these geopolitical tensions that are exacerbating that. So the energy price inflation is, from an Irish perspective at least, unprecedented in the last 20 years. We're looking at a rate of close to 30%. And that is very real, but it is very much imported. If we look at the price levels and just look at the products we buy from energy, the price levels themselves are not necessarily unprecedented. So here we have from the CSO again, the national average price of a litre of unleaded petrol. And that, the last time it was below €1 was back in 2005, so 16, 17 years ago. And it has varied since. But the current price, now this data only goes up to November, so I think we might be in unprecedented terms now. But if you go back to 2011, 2012, when there was a big spike in energy prices, the price of a litre unleaded did go over €1.60 briefly. So it's not entirely unprecedented. the current levels we're at, but it did fall away from it. And what we're seeing now, of course, is again that very rapid rise in prices. And it's that sort of disruption by those changes that is impacting people. If it happened on a gradual basis, like that increase from 1998 through to 2006, 2007, people can respond. But because we've seen such rapid changes in such a short period of time, that is creating many of the difficulties that people are facing that's simply happening in an unexpected fashion. So given that the level of inflation, and given that the mandate of our central bank, the European Central Bank, is price stability, what are the likely responses to this, and how might they differ globally? And if you look at what the ECB has done over its history, its life, when it comes to interest rates, these again have an up and down pattern. So this is the key ECB interest rate. So the benchmark ECB interest rate going back to the year 2000, we could go back for one further year. 1999 would have been the first year that they set it, rising up to 2001, then falling in the aftermath of the recession after the September 11th attacks. Stable then through 2003, 2004, 2005. Then, as there was sort of a mass expansion of credit and inflationary pressures right around the world, significant rises in interest rates from the middle of 2005 to 2008. They maybe came a bit too late for Ireland. We possibly needed higher interest rates to begin from about 2002 to quell some of the imbalances that were building up in our economy. But interest rates reached around 4.5% at the time of the crash. And then you can see them falling over a cliff, going vertical in response to some inflationary pressures in 2011, 2012. But actually, when we look back, we see that they were driven by energy. We're talking about that price of petrol peaking in 2011, 2012. The ECB at the time under Jean-Claude Trichet decided to increase interest rates in 2011, 2012. But that turned out to be a foolhardy move. Inflation faded away. In fact, the recovery faded away. And ECB interest rates have fell. And in unprecedented terms, they've been zero. As we can see in the chart, they've been zero since March 2016. So we're coming on close to 6 years of 0% interest rates, the key benchmark rate for the ECB. Some ECB rates are negative. If banks put money on deposit with the ECB, they will be charged a negative interest rate for doing so. So we have been in extraordinary times for interest rates in recent years, with them being close to zero. So are we about to see them change? And here we see sort of a differing forward guidance from what the Federal Reserve and what the Federal Reserve are doing in the US and what the Bank of England are doing in the UK, with the Bank of England recently deciding to increase its key interest rates. For the euro area and the ECB, the line has been that there's no need yet, at least, to increase interest rates, that much of the inflation is imported or temporary, and that we're in a position where, as of yet at least, there's no need from a European perspective to increase interest rates. Now, it's not a bold prediction to say that EU interest rates and euro area interest rates will increase, but when? So that the forward guidance at present, and Ireland's man in Frankfurt, Professor Philip Lane, former governor of the central bank, the replacement of Governor Honan, who was mentioned earlier, he is now the ECB's chief economist, so undertaking their key analysis on inflation. And his view, and that feeding through to the ECB in the main, is that some of this inflation is temporary and doesn't warrant or respond a policy interest rate change. We'll see now how that plays out over 2022. But it's clear that in some senses, markets are considering a possibility of interest rate increases. And here we're looking at the interest rate in Ireland's government bonds, Ireland's 10-year government bond. We could have chosen any of them, and we could have chosen any interest rate across the euro area. So this is Ireland's 10-year bond going back over the last 5 years. And we can see like the numbers here are all very, very small. There's nothing over 1% over a 10-year period. So the Irish government over this entire 5 years can borrow at very, very low rates. And you can see actually late 2019 right through 2020, through the most of 2021, at times the interest rate was negative. That if you lent money to the Irish government over 10 years, you get less back based on the price you had to pay for a 10-year Irish government bond. In part, now this is driven by the attitude and the policy of the ECB, that what has clearly been a public health crisis for the past 2 years wasn't going to become a sovereign debt crisis or a public debt crisis, that governments will be able to borrow to respond to the public health crisis without concerns for interest rates and debt sustainability, at least in the short term. But for the last 5 or 6 weeks, we can see the interest rate starting to tick up. It's no longer near zero. It's still below 1%. What are a number of factors? This, again, we can't discount the impact that the Omicron wave is having on financial markets, and the fact that maybe the impact on economies didn't turn out to be as serious as might initially have been feared if Omicron was as detrimental to health and also economies as might have been feared. And then you have the issue that maybe people are expecting interest rates to rise. So the price of these bonds might be falling, people willing to pay less as they're expecting interest rates to rise. So there is some indication that markets are looking at a possibility, at least, of interest rates increasing. But again, hard to disentangle the two effects. They really are only back at the Irish 10-year bond yield to where it was at the start of 2019. So are we looking more at a reversion to normality rather than a outright prediction of interest rate increases? And you have to balance the economic performance and the impact of the pandemic. But it's pretty clear we are experiencing very rapid increases in prices, in large part, at least up to now, driven by energy. The concern for central banks and policymakers, do you get into a price wage inflation spiral? We're not there at present, but it is something that historically, at least, policymakers would be concerned about. And when it comes to interest rates from an Irish household perspective, a lot of concerns will be raised about the impact increased interest rates will have on borrowers. And there's no doubt that there are Irish households that have significant amounts of debt. And if interest rates were to increase, even by a small amount, it would have a significant impact on them. But actually, if we look at the balance sheet of the Irish household sector, we have way more deposits than we have loans. And this gap is something that has opened up and widened over the last 2 years as deposits have soared when the economy was shut down. Not everyone, but many people are in a position where their income was unaffected. And with spending possibilities reduced, we saw deposits soar. And in fact, if you look at the most recent figures from the central bank, Irish households have around 180 billion on deposit. Of course, most of that at close to 0% interest, and about 130 billion of loans, mainly mortgages drawn down. Of course, some of those directly linked to ECB interest rates. But there is a pretty significant gap. That's 50 billion more on deposit than we do have borrowed. And the impact of any possible changes in interest rates on that will be significant. Now, there is, of course, distributional effects. The deposits are likely to be held by older households that are maybe longer into their working life, that have reduced their debts and a possibility to build up deposits, whereas the loans will likely be held by younger households who've taken out a mortgage and seeking to repay those. So again, maybe we have an issue of where does the burden fall if we were to get changes, and with interest rates, it's likely that if deposit rates were to go up, the beneficiaries would be older households that have built up their financial assets, and whereas those to suffer due to that interest rate increase would be younger households seeking to reduce and repay their financial liabilities. But from an overall perspective, when it comes to the headlines about interest rates, it should be remembered that we now have 50 billion more on deposit than we have drawn down in loans. And from an economic perspective, it will be interesting to see what happens to this behavior. Is the saving behavior going to continue? Are people going to continue to build up deposits? Or will we see people return to spending? I think it's very likely we'll see people return to when the opportunities arise. People will spend, and I think in the early part of the year, we're seeing significant pre-booking in terms of travel, international travel, holidays, flights, a return to international tourism if possible. So the appetite is there to spend. And if the opportunity arises, people will choose to do so. And then you're considering the impact of inflation. If you have money sitting in the bank and you want to spend it on something and you're seeing the price rise, what impact will that have on the decisions people make? Will they look to hold back and maybe hope that this inflation is temporary, maybe prices return? Or could they be encouraged to spend even faster in the view that prices may continue to rise? When it comes to loans and looking at that loan liability figure there, it would suggest that maybe Irish households aren't borrowing any money. We're looking at the loan liabilities continue to decline, not at the rate they were maybe up to 2 or 3 years ago, but still there's little or no indication of an increase. That's not to say that people aren't borrowing money. It's just that the repayments on existing debt is offsetting any new debt that's been drawn down. And this melange of colours is just the number of loans drawn down by first-time buyers on an annual basis. So it's quarterly data from the Banking and Payments Federation. But just looking at the number of mortgages being drawn down, and in the absence of the pandemic, which caused a temporary drop in 2020, you're looking at around 22,000 loans being drawn down by first-time buyers. This is not total mortgages. This is just by first-time buyers. And it's broken down between loans for new properties, newly built dwellings, and the majority of which are loans for existing properties. With 2 million houses out there, and about 50,000 of those change hands every year. So it's not that there's no borrowing being undertaken, it's just that the repayments and maybe some of that money that's not being spent is not going on deposit, but is going to repay debt. So we are seeing significant numbers of loans being drawn on. And it is an increase from the depths of the recession in 2011, 2012. Now, it's not to say that 20,000 first-time buyer mortgages a year is the right amount. I think it's pretty difficult to pinpoint where that might be, but 20,000 is still a pretty significant amount. We're looking at maybe 400 first-time buyer mortgages being drawn down on a weekly basis, maybe somewhat counter to some of the headlines that we might feel out. There's no doubt that it's difficult, but first-time buyers aren't in zero. A measure of inflation that's not in the consumer price index is house price inflation, and typically this doesn't have a whole lot of divergence in it. But actually what's noticeable in the last couple of quarters, if we look at house price inflation in Ireland and break it down between new and existing dwellings, I remember we're looking at about 50,000 existing dwellings being sold on an annual basis and maybe 12 or 13,000 new dwellings. So the level of inflation in house prices is very much driven by changes in prices for existing dwellings. And actually, if we look in the last couple of years, inflation for new dwellings has actually been relatively muted, between 3 and 4%, almost for the last 2 years. Recently, house price inflation has begun to surge, and the most recent figures put it, I think, at around 13 or 14%, as it's shown there. But that's driven almost all by existing dwellings. So it's the prices of existing dwellings, which is creating this wide divergence between new and existing. We're still seeing pretty rapid increases. It's possible that price inflation for new dwellings will just catch up. They'll see what's happening. And I think we're seeing some examples of schemes having prices for subsequent releases of properties at higher prices. But it certainly is something that is quite elevated at present. Is it based on the amount of savings people are doing and deposits that are available, and maybe a rush to purchase? But again, you'd have to wonder about the sustainability of price increases north of 10% per annum that we've seen in recent figures. So that's looking at inflation in large part, at least for now, it's driven by international factors, but very much on the housing front, driven by domestic factors. Looking at the government's finances, just to pick one issue within the broad remit of the public finances, we could look at spending, but I think one significant one is on the tax side. And this is something that is going up and up, and at least up to 2021 and up. And one begins to wonder whether we are starting to fly too close to the sun. And that's corporation tax revenues, which back in the 6-7 years ago were about 4 billion per annum. But last year were an incredible 15.3 billion, a huge rise, no sign of a pandemic here. In fact, corporation tax revenues got stronger and stronger and now are a hugely important source of tax revenue for the government. 1/6 of exchequer tax revenue coming from our exchequer revenues coming from corporate taxes, and it hasn't really been a policy choice to have corporate tax revenues near quadruple in quite a short period of time. It is very much, again, like inflation, based on external factors, based on the performance of companies and based on external changes. But just looking at some of the features of Irish corporation tax revenues and some of the bizarre outcomes that have risen. If we look at the corporate tax payments of US multinationals, so this is the amount of corporate tax that US multinationals say they pay to governments of the EU. Now they're saying this to the IRS, the US taxman. So we'll assume if you're going to provide accurate data to anybody, it will be to your tax authorities. This is from country by country reports that US multinationals have filed with the IRS. The IRS have aggregated them and produced summary statistics. So here is the amount of tax paid by US multinationals to the governments of the EU. This isn't scaled by anything. This isn't scaled by national income, scaled by size. This is just the raw amount. And incredibly, the most recent data is for 2018. The country to which, the EU country, to which US multinationals paid the most corporate tax was Ireland. One of the relatively smaller countries in the EU, but about $8 billion reported by US multinationals has been paid in corporate tax to Ireland in 2018. And once we get the 2021 figures, we can expect that to be significantly higher. And maybe this chart will look even more bizarre. Now, typically when it comes to presenting information like this, you'd look to scale it. Like, how important is that? Like, these nominal amounts, while interesting from a sort of a ranking perspective, see that Ireland is right there at the top. It doesn't tell us the relative importance. Like, that Germany is second, but like 5 billion of corporate tax in Germany is likely to be relatively small. So typically when it comes to stuff like this, we'd scale it. And one way in which you can scale it is by looking at as a share of national income. How important are these receipts just from US multinationals as a share of your national income? And here we can see that Ireland again comes out first. Now Luxembourg, which is no bigger than Limerick, comes second, but they're relatively small. And you can see how important are the impact of the corporate tax payments of US multinationals across the countries of the EU. It's all less than 0.5% of national income. In fact, for most, it's less than 0.1% of national income. You can see Germany sliding away down there to the middle, with, even though the receipts are 5 billion and they're second, given the size of the German economy, they're actually relatively insignificant. But for Ireland, the 8 billion we were collecting was about 3.5% of our gross national income. So we are now getting a very significant amount of our national income from the taxes paid by US multinationals. And this is a bit of an unintended success. We were looking for employment and investment, and maybe now the tax payments are sort of an unintended benefit from the policy we've been following for the last number of decades. An alternative way of looking at this sort of scale of the receipts is just to do with per capita as a head of population. Now, this is overall corporate tax revenues, not just from US companies. This is total corporate tax revenues. Remember, Ireland is in the unusual position where most of our corporate tax revenues come from foreign companies. For most of these countries, they'd be collecting corporate tax in their own companies. So it would be a withdrawal from the economy, looking for the government to spend it. From an Irish case, this is very much an injection. In this instance, Luxembourg is removed. They require a very high scale, and Luxembourg is unusual for many reasons. One being just the number of people who work there but don't live there. So corporate tax receipts on a per capita basis might not be that instructive. We can see Ireland relative to the rest of the EU 14 and most of the Western European countries. And none of those, for 2020 at least, had corporate tax revenues of more than €1,500 per capita for every man, woman and child in either the Netherlands, Denmark, Sweden, Belgium, those closest to that. If you look at where the 15 billion for 2021 will put us, we have a population of around 5 million. So lots of zeros, but 15 billion divided by 5 million gets us €3,000 per capita, double the next in the EU 15 ones or 14 ones we ignore, Luxembourg, and far in excess of the likes of France and Germany. which are close to maybe €1,000 per capita on an annual basis. So our corporate tax receipts are hugely significant. Don't want to spend a whole much time looking at particular numbers, and there's a vast array of numbers on this, but just to look at the performance of some of the ICT multinationals in Ireland, and the numbers are staggering. So these are the recent income statements for Google, Apple, Facebook, Amazon, and Microsoft. And the total figure is sufficient to look at. Like, their income before taxes for 2021 was more than $350 billion. Like, the profitability of these companies is staggering. Now, they do pay significant amounts of tax in cash terms. They paid $64 billion of cash taxes in 2021. Now, the bulk of that, of course, would be paid to the US. But given their presence in Ireland, some of these companies are making very significant tax payments to Ireland. So our tax payments are, yes, influenced by international changes, but also influenced by the performance of companies such as these, and whether these companies are maybe now flying a bit too close to the sun, and some of this might reduce. So just to conclude, the two issues we've looked at, one is inflation. I think from an Irish perspective, and maybe even from a Euro area perspective, it is still largely imported, but that's not to say it will stay like that. The international, and from our perspective, the ECB response will be particularly important. Is the inflation permanent or transitory? In the US and the UK, there's a view that some of it is structural and permanent. They need to respond. The attitude in Europe and the EU has been that it remains transitory, and that our policy response, at least for now, is it necessary. And then if we look at corporation tax, a huge surge in receipts for Ireland, mainly paid by foreign-owned companies, in particular US companies. International changes are important, and maybe we might come back to those. And here, are these receipts for us permanent or transitory? They have been around for the last 5 or 6 years. There's no indication as of yet that they're about to evaporate, but it certainly is a significant risk. And I'll leave it at that for an economic update.
Thanks very much, Seamus. As always, which was really illustrating and really just bringing out some sort of quite, I suppose, unique factors for Ireland as well. I suppose it's interesting. Global central banks have really been operating, I suppose, that sort of expansionary monetary policy, essentially nearly since the financial crisis. Really, it's just been quite accommodative, and really actually into that period when an economic recovery started. So I suppose sort of arguably pouring petrol on the flames, and the normal rules then would have been inflation would have followed pretty quickly, but it looked like the laws of financial gravity had ceased to apply there for a little while. But like, has it turned out now though that maybe, global central banks have been sort of caught asleep at the wheel? Is it too late now to take away the punch bowl, by increasing interest rates, or actually are there measures that they can take now to get things under control and then without torpedoing the recovery?
Yeah, I think very interesting sort of perspective on how we got to ourselves into this position. Like, how did interest rates get to zero and stay there? And I suppose you could look at the balance sheets of central banks and say, well, they were pumping huge amounts of money into financial markets for the past 7 or 8 years. So like the 2008 crisis now it's almost historical. That's 15 years ago. And we were looking at the recovery from that, and you'd have maybe expected that monetary policy would in some sense have normalized in the period, that you would have got back to a case where interest rates wouldn't be zero and central banks wouldn't be pumping tens of billions into financial markets by buying financial assets. Like why can the Irish government borrow so cheaply? Like, we now know that they're going to have 230, 240 billion of debt at the end of this. Would you lend to them at less than 1% over the following 10 years on their own? No. But given that we know that the ECB are behind them, and that if you do buy the government bonds, they're likely to buy them if you want to get rid of them. And that's why the interest rate is so low. Why didn't the inflation rise over the last 10 years? Well, it certainly wasn't due to inactivity by central banks. As we said, they had interest rates at zero, and they were pumping tens of billions into financial markets. In part, it was down to maybe poor economic performance, while the Irish economy was going through a very, very strong recovery from 2013, 2014 on. The European economy was recovering, but it wasn't expanding to the same extent, and there wasn't the same sort of pressures on resources. Unemployment was still 7-8%, so you weren't seeing a tightening there. So even though central banks were running very loose policy, it was into economies that had capacity. But interest rates of zero are unprecedented. And then when the pandemic hit in 2020, central banks couldn't cut interest rates. At least they weren't going to cut the benchmark rate below zero. So they pumped even more money into financial markets. So maybe now, as you said, we have this sort of buildup of these very low interest rates and this huge amount of money that's leading to the inflationary pressures. But it's still, the changes have been so rapid in such a short period of time. It's not clear that they do need to take away the punch bowl. I would sort of lean a bit towards the Philip Lane school of thought, at least at the moment, that from a European perspective, the inflation isn't driven by domestic and underlying factors. It's driven by energy prices, geopolitical things, and maybe some supply chain issues that will take a while to grow up. And maybe we'll be here in 12 months' time with inflation at 6% again and saying, well, why isn't this reduced? It's now become embedded and we're looking at 6%, 7% wage growth, and you are in that inflationary cycle. But from the perspective of where we are in the middle of February 2022, from a European perspective, I don't think there's a need yet to take away the punch bowl, but I wouldn't dismiss it.
Okay, very good. And isn't it interesting that divergence in approach? I suppose for a long time now, central banks, global central banks seem to have been operating nearly in lockstep, between the ECB, the Fed, the Bank of England, and now we have this sort of divergence between, as you say, the maybe more cautious ECB approach, and then the Fed and the Bank of England taking steps sort of immediately. Is that a little throwback, do you think, maybe to that 2011, 2012 period when it looks like maybe the ECB panicked a small bit, increased rates, impacted on the recovery then? Have they learned from that?
I would hope so. And I think like most would view that as being a sort of a very negative episode when it comes to ECB policy setting. And like if you look at what's happening over in the UK, like they had their last policy meeting, I think about a fortnight ago, and they voted to increase their benchmark interest rate by 0.25 percentage point. Now the vote was 5-4. So you might think that there's 9 sitting on their committee that decide the interest rate. 5-4, that was quite close. Maybe they weren't going to change it at all. But actually, when we look at the minutes, there was 5 that voted for a 0.25 point increase and 4 voted for 0.5 point. So like the ECB is a very long way from that. Like some governors of national central banks, the Dutch and the Germans might expect, have come out to say that they think EU and Euro area interest rates should rise by the end of the year. But they're nowhere near a majority on the voting of the ECB's governing council. But again, you have that difference like in the UK. Yeah. Now, I think with the UK, it is a bit different again. They have structural issues. They have upended their economy a bit with Brexit, and they're perhaps facing higher levels of inflation that maybe the Euro area isn't experiencing. But I think you're right. This divergence is unusual. They have been in lockstep for the last 15 years. But now we're seeing a bit of a divergence between what's happening with the ECB being the one that's different now to the likes of the Federal Reserve and the Bank of England. Yeah,
it'll be interesting. We haven't seen that sort of difference in approach in a long time now. So I think there'll be unintended consequences, no doubt. Just to remind everybody, pop your questions in the Q&A function there on Zoom, and we'll pick them up as we're going along. Shims, maybe just one other thing that struck me, as always, the statistics on the corporation tax are just like eye-popping. It's just really is amazing. Like, really, I suppose there must be a point where that has to sort of flatten out. Hopefully, it won't fall off a cliff or anything. There must be things like even things like competitive constraints. Ireland is a small economy. There's going to be labour force size, wage inflation, infrastructure limitations. We talked about housing, even water and electricity supply. These are, when you see data centres being told they can't come on the grid, these are all things now that have to at some point impact. If we don't, get our investment in this infrastructure really running quickly, they'll have to impact on the sort of natural capacity of the Irish economy to continue to accommodate that type of growth. Do you think, or will it keep going up and up?
No, I think like resource constraints are real. Like it's odd to say, but like from an FDI perspective, like the success has almost been nearly too strong. It just continued over the last 10, 15, 20 years. You wouldn't say give it up, And you would say, like, how do we accommodate it? How do we ensure it fits into the economy? Just given the benefits in terms of the employment, the investment, and of course now the maybe unintended benefits of all these corporate tax revenue. But I think when it comes to investment decisions, like tax is certainly going to be on the list. It would have always made the top 10, but might have ranked, I don't know, maybe mid-table, 4, 5, 6. Given some of the international changes, it's possible that the ranking of tax could slip down, maybe be 7, 8, 9 on the top 10 list when companies are deciding where to place their FDI. And now, as you say, you're right, it's infrastructure, it's housing, it's the capability to absorb that. We're still seeing a pretty strong investment flow, particularly in pharmaceuticals. Recent announcements by a number of companies to set up operations in Ireland. Like, we do have a strong reputation for delivery that other countries simply can't replicate. We've had many of these companies here for 30, 40, in some cases near on 50 years. So we are a strong applicant when it comes to new investment. But if they hear murmurings from their staff that they can't find somewhere to live, and they're looking at life satisfaction for their workers, they may decide we should go somewhere else. So I think you're right. Some of those infrastructure concerns are significant. It's something we typically don't get right in Ireland. We spend lots of money when we have it, as we did up to 2008, and then we turned the tap off completely on infrastructure within the crisis. And now we're maybe seeing some of the negative consequences of that.
Actually, we've an interesting question from you, the audience on this point as well, around the inability of the Department of Finance to actually estimate these amounts. I know they keep going up, but they never seem to. There seems to be very difficult to sort of get it right or get it close. And we know the companies. You can have a general sense of how they're doing. Like, that must have significance also from a planning perspective for governments and for the Department of Finance. Is there any particular reason why we always seem to be getting that wrong?
Yeah, and I was getting it wrong in the same direction.
Yeah,
it's been a positive error for.
It's been we've been lucky so far.
I guess when it comes to forecasts like this, there would be a certain amount of conservatism with a small c within the Department of Finance, in a sense, particularly maybe around budget time, not wanting to make things look as if the coffers are overflowing. And there may be sort of a certain reluctance to estimate these really high receipts that we're seeing. But in some instances, like the errors have been huge, like billions. And as you say, maybe we can forecast some of them. But really, in large part, it's maybe down to corporate decisions within these companies. What assets are they located in Ireland, and their profitability? Like, so we looked at the outcomes for Google, etc., for 2021. Like, it's only really when those results were published in the last few weeks that you could see the amount of profits they were earning, and far exceeding the forward guidance that those companies were issuing. So yes, you could take issue with the Department of Finance that they keep underestimating corporate tax revenues, and they keep issuing warnings of potentials for declines in Irish corporate tax revenues. Just like interest rates, I can make a fairly safe prediction that Irish corporation tax revenues will fall at some stage. I don't know when that will be, and I don't know by how much they will fall, but they simply, I really don't see how they can keep going up and up.
Yeah. Very good. Actually, we have a couple of questions coming in for Liam and Sarah as well. So, Sinead, are we able to pop the guys? Great, very good. So maybe, Liam, just to I'll put the regulator's hat on for a minute on their behalf. Like, I suppose, isn't there, and this has come up in from a couple of different questioners as well. Basically, isn't there a risk that giving the CBI that growth mandate leads us back into the boom bust cycle that caused the bailout? The industry has stakeholder engagement, has opportunities to make representations, and maybe they're best placed to do that rather than have maybe the central bank should just be the regulator. What do you think about that?
Yeah, I guess. Look, I mean, well, number one, I guess what I was advocating for primarily is that we have a debate on this subject, on the proper role and objectives of the regulator now 10 years on from the collective trauma of the bailout. But in terms of the question, I don't think, no one is advocating for a return to the days of the boomy boom, to quote one of our former Taoiseach. I think what and the point about stakeholder engagement is well made, and the UK paper makes the point very strongly that stakeholder engagement is one of those pillars which is absolutely essential to have in order to produce efficient regulatory outcomes. No one equally would suggest that the regulator should become, and these are getting confused. I mean, the industry advocates on its behalf, absolutely, and it's better placed to do that than the regulator is. The question is whether the regulator should have a responsibility when it's making regulatory decisions to be required to balance the potentially conflicting objectives of growth together with financial stability and consumer protection. At the moment, they steadfastly, in certain quarters of central banking, say, absolutely not. We don't even want to think about growth. And my question is, why not?
Okay, very good. Thanks, Liam. Sarah, you had mentioned that financial inclusion is a priority for the government, and that has fed into the Action Plan 2022, I think. How is that actually specifically addressed, or as to how it might be achieved?
Yeah, thanks, Phil. It's a good question. So I think this is linked somewhat to the 2030 digital compass that I mentioned at the EU level, where I think it's one of the aims is to ensure that 80% of EU citizens have like basic digital skills. So I think during COVID, I think there may have been a bit of a gap of knowledge across certain of the consumer base as to how best to use technology. So there is going to be action over the coming months between the Department of Finance and the Consumer Protection Authority to publish some information leaflets and other paraphernalia for consumers for the purposes of, I suppose, highlighting the benefits that technology and financial services using that technology will bring to them in respect of their financial well-being. But like all pros, there are always some cons. So highlighting the risks as well that those consumers will be exposed to. And I think that dovetails somewhat with the Central Bank's Consumer Outlook report from last year, where the risks that technology poses to consumers was highlighted. So I think that on that front, the action plan is geared towards maybe just fixing that gap a little bit. And there's also mention in the action plan of the Department of Finance working on the consumer protection framework itself and further enhancing that. And equally asking the financial service providers themselves to take steps, I suppose, to focus in again on the consumer and ensuring that their experience when using the products and services is geared towards their well-being.
Great, very good. Thanks, Sarah. Seamus, maybe just briefly hopping back to the corporation tax point, because the other development, obviously, since the last time we were chatting here, is that Ireland has now signed up to the OECD global minimum effective corporation tax rate of 15%. Were you surprised to see us do that? I suppose after all the tough talking from Pascal of red lines and things like that, but that we actually did blink, or were we left with no choice and we just did the best we could in the circumstances?
Yeah. I think your final point there kind of sums it up, that really, given the international pressure, given the limited number of companies or countries who stayed on the outside, it probably was inevitable that Ireland was going to sign up. I was really surprised that a greater group of smaller countries didn't come together to push back against it, because this is very much driven by the larger countries. Like the minimum effective tax rate you talk about is about narrowing the gap between that smaller countries can generate using lower corporate tax rates versus the larger countries. Like if you're a small country such as Ireland, cutting your corporate tax rate doesn't cost you a huge amount. Or you could look at it, the amount of investment you have to bring in to cover the cost in overall terms is actually relatively small. We're a small economy. If we cut the corporate tax rate, as we've done for decades, bringing in some investment will cover most of that cost. But if you're a country like France and they decide to go for a very low corporate tax rate to attract investment, just given the scale and size of the French economy, the amount of investment they'll have to bring in to cover the cost of cutting the corporate tax is simply impossible. So there are legitimate reasons as to why smaller countries have lower corporate tax rates than larger countries. And what the big countries have done, driven by the G7, is trying to narrow that gap. And that's where that 15% rate came from. The 15% itself isn't that significant a change, but I think now that the principle has been set, who's to say in 5 years' time they won't say, oh, that rate should be 18 or it should be 20. And that will significantly narrow the gap. And also with the second part of the OECD agreement, to have more tax paid where the customers are. Again, this favors the larger countries, and the larger, richer countries in particular, because they're the ones where most of the customers are. It's not going to favor the likes of Ireland. We make the stuff, but the customers are elsewhere. And if more of the taxing rights goes to the larger countries, well, that could potentially bring about that small drop we've been talking about in Irish corporation tax revenues. So I think it's kind of surprising that more small countries didn't form a coalition to come against it. And when that didn't happen, we really couldn't be left on our own, and there wasn't a coherent coalition to cling to. So signing up was in a sense inevitable. Yes, there was a change in the language where it initially was that the rate would be at least 15%. And that would be very important from the perspective of EU negotiations, because at EU level, this will be implemented via an EU directive, where the EU member states come together to agree that. And if the OECD agreement was at least 15%, who's to say the EU directive wouldn't have been that 18 or 20%. So getting rid of the words at least was quite important, because Ireland can now say at EU level, look, we agreed to 15%, and we do continue to have a veto at EU level on such matters, and other countries are likely to hopefully see it similarly. Just looking at the impact of it, I think like this isn't the first time that Ireland's corporation tax regime has changed, but it's the first time that somebody else has changed it. Like we initially had a 0% rate, go back to the late 50s, early 60s. Then we went to the 10% rate in the 1980s. Then we went to the 12.5%. Each time we were asked to change, we got to choose what the replacement was. In this instance, the rate was set by an outside agency. So there was the view at the time back in October, oh, it wasn't as bad as it could have been. Just because something is as bad as it could have been doesn't mean it's good. I think we have given up significant sovereignty on a key part of our economic policy decision-making. And in many cases now, the principles have been set. More and more of the taxing rights could go to the customer countries. A much higher, or at least a higher minimum tax rate could be set. The principles are now in place. And I think the impact of this won't be felt in the medium term. It'll be out over the long term, 2020, 30 and beyond. So quite a significant change, but we're not going to feel it straight away.
Okay, very good. Thanks, Seamus. It's interesting actually as well, shows maybe how it's sort of moving into the rearview mirror, how little we've talked about COVID, I suppose, in the context of all this and the impact on the Irish economy. But I suppose maybe there's a couple of questions on this amongst the audience as well. Like, is this concept of sort of long economic COVID, is that something that that we're going to have to deal with, which is the amount of money that governments have had to borrow to support their economies, and also the inequality, I suppose, or the impacts that has created, because wealthy countries have been able to borrow to deal with COVID, and less developed countries haven't. There's a huge amount has been added to sovereign debt to deal with this. Do you think is there going to be special measures or anything maybe to deal with that, or is it something that just simply is just going to have to be brought on the balance sheets and dealt with? And so that ties into, for example, this is where you could have the perfect storm, where our borrowing has moved up to, national debt nearly 200 billion now, and then say if we had a fall off in corporation tax receipts and things like that, things could change very quickly.
They could indeed, and I think, like with many of these things, that the policy choice is to kick the can down the road, and that's what we've done. Like, governments have borrowed the money, and in many cases it wasn't necessary given the public health measures that were put in place. It wasn't an economic decision that led to the increase in debt. The policy was driven by public health, and that's where the expertise lay. But as you say, the debt has increased significantly. Now, because of the actions of the ECB, we do have most of that tied in and locked in at relatively low interest rates. So it's not something that's going to come up and bite us straight away pretty quickly. But again, over the long term, when this debt comes to be rolled over in 2030 and beyond, we borrowed it at less than 1%. What are the interest rates going to be like then? If you have 250 billion of debt and interest rates then are 5, 6, 7%, then over a period of time, your interest bill can begin to ramp up. So I don't think it's an issue for the near term. The government isn't going to seek to repay that debt, but it will look to roll it over. But that isn't for a period of time. In terms of the broader economy and long economic COVID, like huge supports have been put in place for incomes and for businesses. And by and large, they've been successful in terms of achieving their aims, supporting incomes, supporting businesses. Will some businesses struggle once those supports are withdrawn? Possibly, but would that have been the case anyway, with or without COVID? It's very difficult to tell. But I think there is an appetite to spend out there. You can see it in terms of the hospitality sector, in terms of the travel sector. If people are given the opportunity, they will go out and spend. So I think many businesses in those sectors most significantly affected should see an increase in demand. And if they are struggling, I don't think it's necessarily because of COVID or because of withdrawal of government supports.
Okay, very good. Maybe just before we finish up, then there's one further one, Sarah, that you might be able to take. The question here is about the lack of a regulatory sandbox for fintechs and insurtechs, possibly putting Ireland at a disadvantage to the UK, the Netherlands, other EU countries which have that type of facility. Would you have a view on that? Is that something we'd need to look at?
Yeah, so I mentioned the innovation hub there earlier that the central bank put in place, and it's not a traditional sandbox, it's more a sandbox of sorts. So I think there is merit in the argument there that we possibly are at a bit of a disadvantage there, and our fintechs and the startups coming up through the ranks are at a little bit of a disadvantage in that respect. But I think if you look at it more widely internationally, there has been a lot of controversy attached with sandboxes and in the jurisdictions where they've been, established. And I think generally speaking, it's fair to say that the uptake on setting those up has been quite limited. But I think it is a debate that's worth probably opening up and maybe seeking the opinions of stakeholders in the fintech industry and to see whether or not there really is an advantage there for them and for the central bank's involvement in that type of thing.
Great, that's great. Thanks very much, Sarah. Okay, well, I think we've just sort of edged over our time. So actually, just before I thank everybody we finish up as well, just to remind you, a little survey will automatically pop up just as the webinar ends. So if everybody could just take a minute to fill that in, it'll just take a few seconds. That'd be great. It would just help us with feedback for this event and other events. So thanks if you could have a look at that. So really, it just remains for me to thank Seamus for joining us. Seamus, as always, thanks very much for your contribution, really insightful, and to thank Liam and Sarah as well for their contributions. And if there's any follow-up questions or anything from anyone, please feel free to just drop us all an email. I would be very happy to respond to that. So we look forward to supporting you in your businesses for the rest of 2022. So thank you, everybody.